let's get more from a guy who's watching this U.S. inflation closely. We are joined by Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management. Alex, thanks very much for joining us. You're looking out for this so-called supercore number. I will give you that when we get it, but it looks as though the headline CPI in line with expectations.
It does look that way, yes. And I think that overall the outcome is on the surface benign at this point. I think one of the things that really we've been keyed in on is not so much the next Fed meeting. A 25 basis point cut is all but locked in at this stage. Really, we're looking for clues as to what's going to happen in 2 or 3 meetings immediately afterwards. And this would certainly support the Fed tilting towards a softening labor market.
The core reading, and I'm not sure which core reading it is bang on the forecast at 0.3%. And that, I'm sorry, that was the number I gave you off the top, 0.3%. That is the core number. The headline number, and I got them back to back, whatever, mixed up. The headline figure is slightly hotter, apparently, at 0.4%. But the core is up 0.3% month on month in line with expectations. Just remind us, and I'll look for this super core. You're looking for it too. What is that? What is the super core?
So it's a measure of services that excludes energy and housing. And the reason we care about it so much is because it's a very crude proxy for the labor market. The labor market is cooling, but one thing that we think the Fed might use as a reason to be a little bit more complacent about easing rates at the next meeting is just the pushback given where services inflation has gone in the last month. So for context, it printed 0.5% last month. Another similar print, we think you could still see some language around carefully or cautiously in the statements.
So far, the stock market reacting reasonably positively. We saw a bit of buying in bonds as well. Bloomberg says that there's relief that we didn't get a nasty surprise. Just back to that headline number for a second, the index for shelter helping to inflate that number a little bit. And of course, that's been a problem, hasn't it? Just in so many communities, just finding somewhere to live at a reasonable price.
It is, but it's one of those numbers that the Fed can to some extent talk through just because of the way that the index is designed. It's usually very slow moving, and I think really what they're much more focused on are the marginal changes. They've already set up a reason to talk through tariff-related inflation, so really what they're looking for is services. I also suspect that one of the reasons the markets are moving the way they are is because of the jump in initial jobless claims, which came in at 263K this morning. That move higher will be a source of concern and would tilt the Fed definitively towards the labor market at this stage.
Alex, it's John O'Connell at Davis Ray. The question, we've been reading that maybe the labor numbers, forgetting about the BLS and the data collection problems, but more around the administration's policies with regard to immigrants and illegal workers. What do you put any credence in the fact that maybe that's distorting the unemployment numbers and the claims numbers as well?
I think it's certainly a dynamic that could keep the unemployment rate lower than you would expect it to be. Really simple math, if there's a lot of people who are leaving the workforce, regardless of whether they're documented or not, there's a certain number of jobs you have to fill. So what you could see is a bit of a buffer on the unemployment number, and longer term we'll be looking for things like distortions in areas that would be particularly heavily affected by undocumented workers no longer being in the system, things like construction, agriculture. Those areas you could see actual wage inflation.
That's kind of where we're going, Alex. And I guess the other question is, inflation is still running at 3%, 3.1, who cares? But in the overall scheme of things, if the Fed starts easing, we're seeing longer-term interest rates rising in Japan, Germany, France, Great Britain. Do we run the risk where the Fed is perceived, maybe not justifiably or not, to be being pressured to lower interest rates at a time when inflation still is running hot, but the economy is slowing, and we run the risk of the Fed cutting rates and interest rates actually rising from here?
It is possible. And I think that one of the things that you have to pay close attention to here is that while the Fed controls the short end of the curve, investors control the long end. And when you're looking at an era where there is increasing supply, higher interest rates across the board, bottom line here is there's an abundance of choice where you can get relatively risk-free money. So you can see that start to shift. And that's one of the things we're looking at. And we actually had a similar situation to that during the first easing cycle that we got in this period, where you actually saw things like mortgage rates climb on the back of easier Fed policy. So it's certainly not an automatic that the whole curve shifts down as the Fed eases.
What is your, I know we're going long term here, Alex, but do you anticipate in the next decade or so a big deflationary impact from AI? I'm sorry, we've only got about 90 seconds.
No problem. We think that the AI-related impact is modestly disinflationary. And when we look at the longer-term capital markets assumptions that we use, so those are forecasts we have going out 5 to 10 years, some of the scenario analysis we use is suggested to be modestly disinflationary, so probably to the tune of 0.1, 0.2% to overall numbers, which could in turn mean that you see slightly easier Fed policy on the back of that, but it's a very marginal change at this stage.
Alex, I would love to have you back to talk more about it. I really appreciate your joining us today.
Oh, it's my pleasure. Thanks for having me on.
Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management.